Assalamualaikum and hi everyone. I hope you all are having a really wonderful day, and thanks a lot for taking your time to watch our videos. First of all, we're gonna explain about two main topics that we already learned in business accounting. First topic, we're gonna explain about what is basic accounting concept, and another topic is we're gonna explain about sources documents. Don't worry, for those who haven't heard about these two topics, we're gonna make sure everything clear and easy to understand. Okay, first of all, let's have some knowledge about what is the meaning behind basic accounting concept is. Basic accounting concepts are the basic rules used to record and prepare financial information. They help ensure financial records are accurate, consistent, and reliable. This concept can help businesses make better financial decisions. Alright, since we already know what is the definition of basic accounting concept is, we're gonna proceed to more detail about basic accounting concept. Hi everyone, my name is Nur Azwa Safrina binti Azhar, and you all can call me Azwa. My matrix number is 01DIF26F1007. Today, I'm gonna talk about one of the basic accounting concepts. I'm gonna explain a little bit about historical cost. Historical cost is the original price paid to purchase an asset. In accounting, assets are recorded at this original cost and usually remain at that value in the financial records, even if their market value changes over time. So, historical cost is widely used because it is simple, reliable, and based on actual transaction. Next, we're gonna move on to another basic accounting concept. Next, I'm gonna talk about what is prudence. Prudence is an accounting principle that means being careful when making financial judgments. It encourages businesses to avoid overstating profit or assets and to recognize possible losses as soon as they are expected. This could help ensure that financial statements present a fair and reliable view of the company's financial position. Since I already done talking about prudence, next I'm gonna pass to my teammates.
Assalamualaikum and hi to everyone. My name is Aina Ishira binti Muhammad Waisa and my matrix number is 01DIF26F1011. Today I will talk about the consistency concept and matching concept. Consistency concept means a business must practice and adhere to rules, assumptions, or principles consistently. They cannot change their practices without constitute reasons, or the easy way to understand what is consistency concept means is a business should use the same accounting methods and policies from one accounting period to another so that financial statement can be compared fairly over time. The second one is matching concept. So what is matching concept? Matching concept is the revenue that we earn in an accounting period must be matched against the expenses incurred in order to generate revenues in the same period. The second one, recognizing revenues that have been earned during the period, whether in cash or not. The last one, subtracting expenses incurred in the earning of these revenues, regardless of whether these expenses have been paid or not. Or the easy way to understand what is matching concept. Basically, matching concept means expenses should be recorded in the same accounting period as the revenue they help to generate.
Assalamualaikum and hi everyone. My name is Alisha Humaira binti Mama Hanafi and my matrix numbers is 01DIF26F1016. Today, I would like to explain about two important basic accounting concepts. First, do you know about accurate concept? Okay. The accurate concept means that income and expense are recorded when they are earned or incurred, not when cash is received or paid. In simple words, accounting focus on when the business activity happens, not when the money changes hands. Okay, next I want to explain about materiality concept. What is materiality concept? Materiality means that only information that is significant enough to influence the decision of users of financial statements needs to be reported separately. Small or insignificant items do not need detailed accounting treatment because they do not affect decision making.
Hi, my name is Alif Nafal, and today I am going to explain about the basic accounting concept, which is the going concern concept. This concept assumes that a business will continue operating for the foreseeable future and does not plan to go closed down or go bankrupt. Because of this assumption, accountants prepare financial statements based on the idea that the business will continue its normal operations. So the next concept is objectivity or reliability concept. This concept means that accounting records and financial statements must be based on reliable and accurate information. Every business transaction should be supported by objective evidence such as invoices, receipts, or other written documents. This helps ensure that the financial information is accurate, trustworthy, and free from personal bias.
Hi, my name is Muhammad Adam Mikael bin Muhammad Hadi. My metric number is 01DIF26F1010. And today I will explain about three accounting concepts. First is the money measurement concept. This concept means that only transactions with a money value are recorded in accounting records. In Malaysia, we use Ringgit Malaysia, RM. It also assumes that the value of the money is stable. Next, I will explain about business entity concept. This concept means that the business and the owner are separate. Business transaction must be recorded separately from the owner's personal transaction. For example, if the owner buys clothes for personal use, it is not recorded in the business accounting. And next, I will explain about the concept of periodicity concept. This concept means that business activity are divided into accounting periods, such as 1 month, 6 months, or 1 year. This helps business prepare financial report and compare their performance every year.
Okay, since we already finished talking about basic accounting concept, next we're gonna move to another topic. The topic is about sources document. First, let me explain a little bit about what is sources document is. Sources document are the original record of business transaction. They provide proof that a transaction has taken place and are used to record accounting information accurately. So me and my team are gonna explain 7 sources documents that we already picked. So the 7 sources documents that me and my team are gonna explain to you all about is first is cash bills, second is official receipts, third is invoices, fourth is memo, next we have a check, second last we have delivery orders, and lastly we have purchase order. So I hope you all will listen carefully to what we are gonna explain about.
Cash bill. Cash bill is a source document issue when goods or services are sold and immediately paid in cash. It serves as the proof of cash payment and the transaction. What is official receipt? Official receipt is a source document issue to acknowledge that payment or check has been received from a customer. It also serves as the proof that payment has been received.
Alright, now I want to explain about invoice. What is invoice? An invoice is a document issued by a seller to a buyer requesting payment for goods or a service provided. As you guys can see, this is an example of invoice. Invoice usually includes the seller's name and a buyer's name, the invoice numbers, the date of the transaction, the description of the goods or service, the quantity and price, and also the total amount due. Okay, now I want to explain about memo. This is an example of memo. Memo is an internal document used within a business to communicate information about accounting, transaction or adjustments. Unlike an invoice, a memo is not sent to customers. Instead, it is used by employees or departments within the company. Memo is also include correcting accounting errors, recording depreciation, adjusting prepaid expense, and also writing of bad debts. That's all.
Alright, let's move on to another sources document that we're gonna learn about today. So I'm gonna explain what is checks. A check is a written document that tells a bank to pay a specific amount of money from the account holder's account to another person or organization. It is a safe and widely used method of payment, especially for a large transaction. So, there are three main parties involved in a check. First, we have the drawer. The drawer is someone who writes the check. Second is the drawee. The drawee, which is the bank that makes the payment. And lastly, we have the payer, who is the person or business receiving the money. Alright, so I want you all to take a look at my right side. This is an example of what checks looks like. So, a check usually includes the date, the payer's name, the payment amount in both words and numbers, the drawer signature, and the check's number.
Okay, next I will explain about the delivery order. A delivery order is a document issued by the seller when goods are delivered to the customer. It records the description and quantity of the goods.
Now, I will explain about the purchase order. A purchase order is a document used to order goods. It is prepared by the buyer and sent to the supplier. This document contains the details of the goods or services that the company wants to purchase, such as the quantity, price, and description. In short, a purchase order helps both the buyer and supplier ensure that the order is clear and accurate. Thank you.
Now, that is all from our presentation. Thank you for your time and attention. We hope this presentation has helped you understand the topic better. If you have any questions, we will be happy to answer them. Thank you and Assalamualaikum. Bye-bye.